Good morning everyone. My name is Christian Palamacosalem from BSBA MK1A. This is the report of Group 3. What is the unit of revenue method? The unit of revenue method is a technique used in the oil and gas industry charging the capitalized cost to expense using the ratio current gross revenue to figure gross revenues. The current gross revenue figure is derived by multiplying actual production during the period by actual selling price, excluding the royalty payments. The figure gross revenue figure is derived by multiplying current price by the estimated quantity of proved services, excluding royalty payments. Revenue describe income generated through business operation, while profit describe net income after deducting expenses. From earnings, revenue can take various forms such as sales, income from fees, and income generated by property. Revenue means the definition says that it is the total amount of the money received from carrying out the business operation, such as sales. On the income statements, it is also known as the sales. It is the top line figure as it is shown first on the income statement of any company. And these are the three examples of revenue are: rent received. Rent received means money paid or payable to you by tenants for accommodation by services provided in the course of business at the premises. Amount received from one-time also sale of an asset. In this amount received from one sale of an asset or financial instrument, it encompasses all forms of compensation including cash, the FMB of any property received, and any liabilities that the purchaser assumes as a result of the transactions. And the third one is the interest received from bank accounts. Interest on a saving account is the amount of the money a bank or financial institution pays a depositor for holding their money with the bank. In a way, a bank borrows money from their depositors by using the deposited fund to lend money to the other customers. Volume of profits. Profits in accounting, profits refers to the difference between the purchase and the components cost of delivered goods and or services, and in any operating or other expenses. In a new classical microeconomic theory, the term profits has two related by distinct meanings. Normal profits represents the total opportunity cost, both explicit and explicit, of a venture to an investor. Whereas economic profit is the differences between a firm's total revenue and all costs, including normal profits. What does volume profit means? A profits volume or PV chart is a graphic that shows the earnings or losses of a company in relation to its volume of sale. The profits volume chart gave a company a visual of how much the product must be sold to achieve profitability. The takeaways of profits. A profits volume PV chart is a graphic that shows the earnings or losses a company in relation to its volume of sales. Second, the profits volume chart gave a company a visual of how much the product must be sold to achieve profitability. And the three, companies can use profit volume chart to establish sales goals, analyze whether the new product will be profitable, or estimate break-even points. The profits volume chart gave a company visual of how much the product must be sold to achieve profitability. The total cost of the company include variable and fixed costs. Fixed costs represent the money spent on needed to produce the product, which can include the cost of the building and equipment. Variable costs represent the costs that influated with the sale volumes, such as raw materials and inventory. If a company produced the zero sales, they would still have an expenses of their fixed costs but would have no variable costs, assuming they didn't buy any inventory. Customer and psychology pricing. Psychology pricing is a pricing strategy that uses consumers' psychology to influence the customers' perceived value of your product. This tactic subtly encourages customers to take actions and make a purchase. An example of psychological pricing is when something priced at $9 instead of $10. And these are the advantages of psychological pricing strategy. Number 1, you drive sale and improves because they base on psychological principles. Once you understand how to motivate customers to buy from your brand, you see the higher conversation and more sales as a result. When done correctly, of course. Now, second, psychological pricing captured an attention. These strategies helps your product stand out and get noticed by consumers. More eye on your product translates to more potential sales. So once you figure your customers' interest, you just have to highlight your product and future to the snag and conversion. And the third, it may shorten the time to purchase. Psychological pricing strategies show customers right away whether your brand can solve their needs for the price they willing to pay. They spend less time shopping around and convert more quickly. What is an example of consumer psychology and pricing? The idea behind psychological pricing is that customers will read the slightly lower the price and treat it as a lower than the price actually is. An example of psychological pricing is an item that is priced at $3.99 but conveyed by the consumer as $3 and not $4, treating $3.99 as a lower price than $4. The idea behind psychological pricing is that customers will read the slightly slowed price and treat it as lower than the price actually is. Price discrimination, aka segments of pricing. Pricing discrimination is the most valuable when the profit that is earned as a result of separating the markets is greater than the profits that is earned as a result of keeping the markets combined. Whether the price discrimination works and for how long the various groups are willing to pay the difference prices of for the same product depends on the relative elasticities of demand in the submarkets. Consumers in a relatively inelastic submarket pay a higher price while those in a relatively elastic submarket pay a lower price. Price discrimination is a strategy in which a seller prices the same product differently across market based on what each market's buyers are willing to pay. And these are the takeaways of discrimination. With price discrimination, a seller charges customers a different fee for the same product or service. Second, with first degree discrimination, the company charges the maximum possible price for each unit consumed. Third, second degree discrimination involves discounts for product or services brought in bulk, while the degree discrimination reflect different prices for different consumer groups. Profit discrimination is the most valuable when the profit that is earned as a result of separating the market is greater than the profit that is earned as a result of keeping the markets combined. Whether the price discrimination works and for how long that the various groups are willing to pay different prices for the same product depends on the relative elasticities of demand in the submarkets. Consumers in a relatively inelastic submarkets pay higher prices, while those in a relatively elastic submarket pay lower prices. Price discrimination is charged customers different prices for the same product based on a bias towards groups of people with certain characteristics. With price discrimination, the company looking to make sales identify different market segments such as domestic and industrial users, while with differences price elasticities. And the price segment is a pricing strategy when you charge different prices to different type of customers based on their ability and willingness to pay. With price segmentation, you make higher profits from customers who pay the most and lower profits or even losses from customers who pay the least. Example of price segmentation. Price segmentation is the process of charging the different prices for the same or similar product or service. You can see example everywhere. Example, student prices at the movie theaters. Senior prices for coffee at McDonald's. People who use coupons and so on. And the types of price segmentation are customers based on segmentations, product bundle based on the segmentation, product value based on the segmentation, purchase time based on the segmentation, purchase location based on the segmentation, purchase quantity is based on the segmentation.